Let me also now bring on board Prashasta Seth, Senior Fund Manager with IIFL Wealth. Prashasta, good morning. Thank you for joining us. Prashasta, we've got $7 billion of fresh global or fresh FR inflows this year. But if I map what benchmark indices have done, we are sitting at a fresh 6-week low. And on a YTD basis, Nifty is now in the red.
So I think, more than the Nifty, I think the performance of mid-cap and small-cap indices, which are down anywhere between 6 and 10%, clearly shows that there has been a local selling in the markets. I think it could be potentially on two counts. One could be the redemption that the mutual funds are facing, simply because I think for many of the investors, the levels at which they had entered has come back, so they would possibly want to move out, meaning the retail investors. And two, essentially, I think you are seeing selling related to OFS and the fact that people, especially the domestic institutions, government-owned domestic institutions, might have sold into the market to fund their applications for OFS. And this is possibly likely to continue for possibly the next 1 or 2 months. So let's see how the global flows stack up. I think globally the equities are in a fairly sweet spot. So hopefully that will mean that funds continue to come in. And if budget is essentially on the lines of what the finance minister has promised to the investors, then you could potentially see some amount of move back up into the market. So we'll have to see on how the budget pans out, and that will potentially give the direction of the market post-Feb.
Prashasta, what did you make of ONGC's earnings?
I think there are 2 or 3 things. One is obviously their other income has been fairly robust. Their DDA expenses have come down. So I think those are the 2 factors that have pulled the earnings and essentially have led to earnings higher than expectation. But core business essentially continues, to be flat. And also, I think in terms of realization, it's coming down, and at $48, it's potentially only 20% above their cost, which is around $40. So, which doesn't leave much scope for them to fund their capex requirements going forward. So, I think the key for ONGC or other oil companies are twofold. One is what happens to the gas price, whether the gas APM price is raised from $4 to $8. And B, what happens on the diesel deregulation front. I think those 2 factors will essentially determine how things pan out for the oil and gas pack. And if these 2 steps happen, you would potentially see a decent up move on the stock. Else, I think you would again see it drifting down to 260, 270 odd levels.
ONGC for this year is up a good solid 20% plus, but on the flip side, JP Associates is down more than 20% from the recent high. JP Associates also late last evening, they came out with numbers. Numbers were way below estimates. The fact that they have a huge debt burden is now eating into their EBITDA profitability. Cement business is going through a cyclical downturn. So the problem for JP Associates is that construction business is not growing, cement business is slowing down, and till the time the company does not raise more repair capital, I think the debt burden will be a sizable issue for JP Associates. But bear in mind, the stock already has corrected more than 20% plus from the recent high. So after poor Q3 numbers, the downside for JP Associates really could be restricted. Prashasta, at the current juncture, would you say JP Associates is a good high-risk, high-return idea if they are able to raise repair capital, or if they manage to, or if they are able to sell stake in their cement business, the balance sheet could look entirely different?
At the end of the day, I think for JP Associates, to do well on a fundamental basis, I think the debt burden has to come down. Unfortunately, the company is in a situation in which the interest cost is more than the EBITDA that the company is generating on a quarterly basis. Until that situation continues, I wouldn't see any fundamental reason for the stock to do well. So I think you need some amount of triggers, like the sale of cement business that has been talked about. Something to happen for the stock to do well. I think till that happens, stock will continue to behave like a typical high beta stock. In an up market, it will outperform, and in a down market, it will underperform. So unless I think I see some action happening which gives me a concrete idea that debt is coming down, I wouldn't kind of touch the stock on a fundamental basis. We have been hearing about the potential deals and deleveraging for quite some time, and unfortunately, for whatever reasons, it hasn't happened to the extent that people were expecting to happen. And you are currently at a situation in which your interest costs are more than your EBITDA, so obviously your debt burden is going to increase on a quarter-on-quarter basis. So you need some sort of action happening and some amount of deleveraging happening to take a fundamental call. Beyond that, I think till that point, I think it's going to be a trading call depending on your view on the market. You have to treat it as a beta play and play it one way or the other.
Do you think in the near term, macros are also looking challenging? Crude is now sitting at a fresh 4-month high, which means Brent is at $118 per barrel, and rupee also has reversed quite meaningfully in last 2 or 3 days.
I think it is crude which is driving everything. At the end of the day, I think we are in a situation in which the current account deficit is at record levels, and it is very, very difficult to finance or continuously finance your high current account deficit on the basis of inflows. We need to either A, get exports up, or B, at least attract more FDIs. We can't continue in a situation in which we are dependent on FI inflows on a month-on-month basis to finance the current account deficit. And I think till that situation persists, your macros are likely to be very, very challenging. And unfortunately, you have a month like this month where oil kind of moves up fairly significantly. I think that is a big problem, and I think that will potentially lead to a lower currency, and it's a vicious circle. So higher oil prices, lower currency, and attractiveness of India decreases, and FI flows come off. So I think it's a challenging situation, and we need to kind of identify some steps which we will have to take to improve exports or make ourselves more attractive on an FDI front, because those are the only long-term solutions that will help us to bridge the current account deficit on a sustainable basis.